Okay. Okay, welcome back. So hopefully everybody had a good weekend, or those of you that are here. Uh, so we've got only a few meetings left, a couple weeks left in the semester. This will be today's chapter is the last chapter that we're going to cover in this class. So we'll finish off with chapter 15 on monetary policy. That's today's material. And then we have one more meeting, and you also have your take-home final that you got to do. And so assuming we get through everything today, which I'm sure we will for the chapter 15 material, what I'd like to do next week, our last meeting, week 16, is we can just do some practice problems and do some review stuff for the final. And then, yeah, that's what we'll do. So this will be the last week of new material, and then we'll do some review stuff and some practice questions and get everybody ready for the final during our last meeting, which is next week. Okay, so next week is our last meeting, so that's, yeah, make sure you come for that. Okay, so what we're going to do today is the last chapter that I want to cover, which is chapter 15, monetary policy. Okay, so you can open up uh, the study guide for chapter 15, which is right there. You can open up the PowerPoint for chapter 15, which is right there, and you can open up the homework. We'll get to that a little bit later, which is right there. All right, so we'll start with the study guide and the PowerPoint. Okay, so monetary policy today, and we're tying in some of the money and banking stuff and interest rates, and we're going to learn about how the Federal Reserve tries to do stuff to try to affect the economy. Okay. All right, here we go. So chapter 15. So we'll talk about interest rates, and then we'll talk about monetary policy. So first of all, and this chapter has a bunch of terms and definitions, and so kind of like last time, there's some things I wanted to define that weren't fully defined, I think, in the textbook or the lecture notes. I mean the PowerPoint, and so the things in highlight yellow, I put in some more information and a link to those terms, which we can talk about more. So first, let's just define what monetary policy is. And so if you go down here, there's a little link to a monetary policy page on Investopedia. But what is monetary policy? So monetary policy, it's really the demand side of economic policy. All right, so trying to affect demand behavior. And specifically, we're looking at the actions undertaken by the nation's central bank. In the U.S. case, that's the Federal Reserve, to control the money supply, to achieve macroeconomic goals, to promote sustainable economic growth. So the Federal Reserve, or the central bank of whatever country you're looking at, is going to use its policy tools that it has at hand to try to do what it can to affect interest rates, and then after that, they'll affect the money supply. All right, so by doing that, by trying to influence interest rates by doing monetary policy tools, they can have a huge effect on the economy, and we've seen that kind of in the last year when interest rates are super low. All right, so all right, so that's what monetary policy is. The Federal Reserve using its tools. We're going to talk about those tools in a little bit, but using its tools that it has at its disposal to try to influence the economy, and either most likely they want to boost the economy and kind of encourage economic growth. Sometimes, if inflation is an issue, they might want to pull back the money supply and prevent inflation, which could be something that happens in the future. But normally, the Federal Reserve, normally policy is used to boost the economy. But there are times when the economy is growing too fast, or we see inflation becoming an issue, and they might want to slow it down. So depending on what the problem is, or the goal is, most likely we're going to be looking at expansionary monetary policy, but we'll also define restrictive monetary policy in which the Federal Reserve kind of slows down the money supply. Okay, so first let's just talk about interest rates on slides 2 and 3. Okay, so everyone knows what interest rates are, but let's define them in this context. So interest rates in this model are essentially the price paid for the use of money. So if you want to borrow money, you got to borrow money at the current interest rate or the interest rate for whatever you're dealing with. The interest rate for a car loan, the interest rate for a mortgage, the interest rate for student loans, stuff like that. So the price you pay to borrow money is essentially the interest rate. And so we know that there's many different interest rates depending on what you're borrowing money for. Okay, but we're going to look at a model that kind of just says interest, like we just use one general range of interest rates. And so what we're saying really is that like interest rates are different between the different business sectors, but the interest rate in general goes up or down. So we speak as kind of the level of interest rates. So if interest rates are up, that doesn't mean that all the interest rates are the same. That means that they're up from where they norm. If interest rates are up, that means the federal funds rate is up. That means student loan rates are up. That means interest rate on mortgages are up. So if all the interest rates are up, that's kind of what we refer to as the interest rates. So we'll speak kind of as if there's only one interest rate, but knowing that there's a whole bunch of different interest rates that kind of go throughout the economy. But interest rates in general are determined by money supply and money demand, which we need to define a little model for. Okay, so this little graph is somewhat outdated, but it shows you kind of different interest rates. So there's 20-year bond rates, and all these rates are probably lower than they appear on this chart because interest rates right now are super low, probably the lowest they've ever been. But like, let's see. So the mortgage rate is lower than 4%, but what we see here is there's different rates depending on what you're looking at. So like credit card rates are always going to be a little bit higher. The federal funds rate is always going to be a little bit lower. Right now it's close to zero. I'll show you some of these rates, the data for them. But there's like the point of this little slide is there's different types of interest rates. So there's interest rates for longer bonds, for short-term bonds, for prime interest rate, which is kind of the reference point for bank loans. Mortgage rates, there's loans for that. There's different loan rates for automobile loans, um, savings bonds, credit cards. So there's all types of different rates. But when we say like interest rates are up, that means that all of these rates are kind of up. And when we say that interest rates are down, that means that all these rates are kind of down. But it doesn't mean that uh, there's still going to be a level where like the credit card rate is always going to be higher than most of these other rates and so on. All right, so just to sum up, so interest rates in this context are the price paid for the use of money, and you're borrowing money depending on which one of these things you want to purchase or borrow money for. Okay, so now we're going to look at a little model, essentially called the money market. And this is a little simple model that you use in macro that kind of helps you determine how interest rates are set with money supply and money demand. So this is the money market and equilibrium interest rates, how those are determined. So if we look at this little model on slides 5 and 7, it's pretty useful. And we're to use it for kind of explaining graphically how monetary policy works. All right, so we learned about interest rates. Now let's learn how interest rates are determined in the money market. So why do you want to hold money? We're going to assume there's essentially two reasons. So why do you want to hold cash or check or money in your checking account? So there's essentially two reasons. One is to make transactions. So if you have all your money in like long-term investments, stocks and bonds, housing, whatever, it's hard to make transactions because you can't buy groceries with a house. You can't buy, uh, you can't go out to dinner and pay with like your stock price. So you got to have some money just to make transactions. So the amount of money in the economy that the economy wants to have for transactions is determined by nominal GDP, and this is essentially independent of the interest rate. So there's always going to be a total amount of money in the economy, which is currency and checkable deposits that in total the economy wants to have just for transactions. So there's always going to be some level of money that we need in the whole economy just to make transactions. That isn't affected by interest rates because you got to make transactions no matter what. Okay, but money can also be an asset, and money becomes more popular as an asset, which we kind of saw last week when interest rates in other interest-bearing opportunities are low. So money has value because your checking account pays little interest, but it still pays some, and it's essentially risk-free. So you can't there's no you're going to get a low return on your checking account or your savings account, but there's no risk. That money is safe. You can't lose it, right? So it's not like stocks and bonds or houses or like Bitcoin where like you might make money, but if the demand for those assets or services goes down, you could lose money. Now, money is essentially money in your checking account or savings account is essentially risk-free because you don't get much interest, but you always get that money secure, right? You're never going to lose it. Okay, so therefore, um, because money in checking accounts and savings accounts are essentially the safest place to put your money, even though you might not earn much interest, then people still want to hold some of that as an asset because it's so safe. So money is a store of value, and money is how it relates to other interest-bearing opportunities, determines how much the economy wants to hold money as just an asset. Okay, and we'll see that this varies inversely with the interest rate, and it'll make total sense because when interest rates are low, like if you can't earn much return in other places, then you might as well keep your money in checking accounts and savings accounts because if you want to buy a long-term bond, we'll look at these things a little bit more. But if you want to buy something that's longer term and interest rates are really low, then a lot of times investors just want to keep it as currency and wait till those long-term returns go up. And this is kind of the problem we're at right now. So if you look at these two together, money demand is determined by how much we want for transactions and how much we want as an asset. Together, it looks kind of like this. So see this part, the panel A, this is the interest rate. All right, so this is just the general interest rate of interest, and this is the amount of money demanded in billions. So the amount of money that we want per transaction isn't determined by the interest rate. It's just determined by how much money the economy needs for transactions. But for the asset part, so see how when the interest rate goes up, what that tells you is that investors are going to see that the interest rate is higher in some other opportunities that pay interest. And instead of having their money in checking and savings accounts, they're going to put their money into those higher paying uh, financial assets like stocks, like bonds, stocks, things like that, or anything that pays this higher rate of interest. But when interest rates are super low, like they are now, then the preference is just to keep your money as currency in checking accounts and savings accounts because you want to wait, or investors tend to wait until the return in the general interest rate goes up, so they just keep their money in uh, savings accounts or checking accounts as well. So what we're saying here is that the transactions demand doesn't depend on interest rates, but the asset demand directly depends on interest rates. When interest rates go super low, people hold more currency because they can't get a higher return in other investments. But when interest rates are high, then it's worth it to put your money into those higher paying interest opportunities. And so that's what we see here. So when we push interest rates low, yes, it's cheaper to borrow, but also a lot of people keep the money as essentially cash and currency and savings accounts because they can't earn interest in other places with low interest rates, and so they want to wait until those interest rates go up. So basically, like for investment purposes, low interest rates are bad, but for borrowing, low interest rates are good. Now, if you look over here, these two green, the panel A is how much money we want to hold for transactions, which is 100 million billion, and then this one depends on what the interest rate is. So if you kind of put these two together, so see how this panel C, this one essentially starts at 100. So basically this plus this is this one. So we need at least 100 just no matter what. And then starting at 100 over here, uh, if the interest rate goes down, the economy wants to hold more money because they can't get interest in other opportunities. So see that? We start here at 100 just for the transactions, and then money demand increases as interest rates go down. Now what we got here is this is the money supply. All right, and so what this determines is if you take these two components of money demand, this and this, you get this one here. So the economy needs at least 100 million just for 100 billion, sorry, just for transactions, and then more depending on what the interest rate is, right? So if it goes lower, then more demand. And then the supply of money is going to be determined by the Federal Reserve, and that intersection determines what the equilibrium interest rate is. So if this is the demand for money, and this is the supply of money at 200 billion, then in this case, 5% interest rate would clear the market, and this would be the amount where the money supply equals money demand. So what you can clearly see is this is exactly how the Federal Reserve can control interest rates. Is what do they do? Is if they increase the money supply, all right, that's going to push this um, money supply curve this way. Increasing goes to the right, and if there's more money in the economy, then the demand for it goes down, and we get a lower, right? So if there's much or if there's a ton more money in the economy like there is now, like in money I mean currency, checking accounts, and savings accounts, then to get money, people are going to be willing to pay less to borrow at lower rates because there's already so much money. So when there's more money, the rate at which people will borrow for it is lower. But when the money supply goes down, there's less money and the demand for it is higher. So by either increasing the interest rate, the Fed can essentially indirectly lower, by increasing the supply of money, the Federal Reserve can kind of indirectly lower interest rates in the economy, and by pulling back or decreasing the supply of money, the Federal Reserve can increase interest rates. So depending on what their goal is, usually it's to lower interest rates, but as we'll see now, interest rates are so low that it's hard to lower them much more than they currently are. But you can see here the two components of money demand, transactions and asset, and then the money supply component there, and then the interest rates determined by the equilibrium between the two. All right. So this diagram, which shows a simple explanation for how the interest rate is determined. So questions on this? Do we see the idea of how we get interest rates in the money market here? Okay. Okay. So we got one more slide. Okay, so the equilibrium interest rate, it changes like I described with shifts in money supply and money demand. So when either money supply or money demand changes or shifts, increases or decreases, we're going to get a new equilibrium interest rate. And the thing that the Federal Reserve controls or tries to control is the money supply. And so by doing that, pushing it up or down, all right, just the amount of money in the economy, they can have a huge effect on interest rates, which they've done in the last year, and that's why interest rates are so low because we have so much money in the economy that the the rate at which people will borrow from it is not very high. So one more thing here is that interest rates and bond prices are essentially inversely related, and so that's because bonds pay fixed annual interest payments, and what that means is that a lower bond price would raise the interest rate. So if you think of, and I actually put a little link to this. Okay, so interest rates and bond prices. So there's a little section, and you can click on the Investopedia, but I just kind of put out a little caption that I thought was important. So bonds have an inverse relationship to interest rates, which means that when interest rates rise, bond prices fall and vice versa. And so there's a little uh, example of why this occurs, and I'll try to explain it. So an easy way to grasp why bond prices move in opposite directions as interest rates is just to look at a zero coupon bond, which doesn't pay coupons. But what it does is it derives its value from the difference between the purchase price and the par value paid at maturity. So if you have a zero coupon bond that's going to give you 950 at maturity, and it has a, and then there's the bond costs 950, and then once it matures, it gives you 1,000. So that is, if you take the return from 950 giving you 1,000, that means you earn a 1 year rate of return of the difference, which is essentially 5.26%. So the idea here is that for a person to pay 950 for that $1,000 in a year, they must be happy with getting a 5% return, which is currently that's a high return. But the point is, if your bond if the bond is selling for 950 in a year, it gives you $1,000, then that's a 5% return. And so clearly, if interest rates go down, then that bond is more valuable because you can earn a lower return in other interest rate markets, right? So if the interest rate in some other opportunity goes above 5.6%, 5.26%, right? If you can earn 7% in some other investment, then you're not going to pay $1,000 for this, right? Because it doesn't pay you what you can get somewhere else. So if you just kind of calculate the return on the bond, you can see that when interest rates go up, the price for this bond goes down and vice versa. And kind of really the same idea with housing. With if you saw or if we did the mortgage-backed securities, we kind of saw how home loans priced as an asset are similar to bonds, and that's why you had those mortgage-backed securities, which essentially turn the mortgage payment into the bond payment. And so what we're seeing now is that if you understand this bond inverse relationship with interest rates, it's kind of the same for homes. And so it's interest rates to get a home loan are historically low. I don't think they've ever been this low. You can get home loans depending on your credit for like 3% or less. And what that does is it pushes the price of the house up because if you can borrow money for cheaper, you're willing to pay more for the house. So if you kind of see how bonds and interest rates are inversely related, really it applies the same way is that interest rates and housing prices are also inversely related because if it becomes cheaper to borrow money, then that person's going to be willing to buy a more expensive house. Where if you're going to pay more in interest, then you're not going to pay as much for the house. And so you'll hear stories of your parents or grandparents paying taking out loans at like 30%, but the price of the house they were buying was like 20 grand. So there's there's a pretty clear relationship between interest rates that you can get it in a mortgage and the price of the home. So if interest rates stay low, it's likely that the home prices will stay high. Okay. All right. So we talked about interest rates. Okay, so we talked about monetary policy, just the general concept. We talked about interest rates, and we looked at how the money market model determines interest rates. All right, and we're now going to, and then we learned that interest rates and bond prices are inversely related, and really the same thing applies where interest rates and home prices are also inversely related because they're essentially the same concept. Okay. Um, Now we're going to talk about the the main point of this, or the main goal of this chapter, is to learn about monetary policy. And so there's 5 tools we're going to talk about in which the Federal Reserve can use. And by using those tools, they can either increase or decrease the money supply. And then by doing that, that affects the interest rate. So let's learn about these tools on slides 8 to 13. All right. So maybe let me, since this is important, and I think this is one of the homework questions, let me kind of make a list in the chat. So there's 5 tools. We'll go through them, but I'll list them numerically just so we can like run a tally here. Okay, so tools of monetary policy. Number one. Okay, so number one is called open market operations, which is when the Federal Reserve is acting to it's either buying or selling government securities or bonds. And so this is the big one. This is the most important and most widely used tool that the Fed does, and this is what they do. So the okay, so government, like a government security or bond, is just a bond coupon or a bond investment from the federal government, which is essentially risk-free because the government always pays its debts, right? And so this is kind of how and there's an infinite number of, like, the government can always sell more bonds, right? And so there's never, this idea never runs out. And so what the Federal Reserve can do, um, when it wants to get more money into the economy, and what they do uh, quite quite often, especially during a recession, is commercial banks and the public can they can okay. So there's when they yeah. So they're going to okay. So when they want to put more money into the economy, they're going to buy a bunch of government bonds from commercial banks and the general public. So there's a ton of government bonds out there held by banks, held by the general public, and what the Federal Reserve can do is buy those assets. And by buying the assets, they take the assets, and then the commercial banks and the general public get the money that the Fed bought. So this it's just like changing money around. But if the Fed wants to get more money in the economy, they buy all these government bonds and securities, and then the banks get the money, right? The banks sell their securities and bonds to the Fed, and then they have more money to lend out. So this is an easy way. I mean, it's easy because the Fed has billions of dollars, but it's an easy way to get money into the economy because they don't really care if they have the government bond um, or the currency because it's the Federal Reserve and they can have either one. So they're not worrying about running out of money or having too much government bonds or whatever. So, but it does make a huge difference when the banks can sell all these bonds back to the Fed and then get more money by selling those, and they can lend out more money into the economy. So this is the easiest way to get money into the economy is for the Federal Reserve to uh, buy bonds and as many bonds as they can from commercial banks and the general public. And you can see that it's a risk-free policy because no matter what, the government's gonna pay back those investments and they can always buy them back. And then you can probably see that when they want to take some money out of the economy, maybe prevent inflation, they can sell those bonds back to the banks and then take the money out, right? So it's kind of an easy way to go back and forth. So if they want to put more money in, they sell the securities. If they want to put more money out, they buy it. I mean, what did I say? Okay, they to get more money in, they buy them. To take money out, they sell them. Yes. All right. So essentially, what we're saying here is that if you look at the graph, okay, so when the Fed buys securities, all right, that gives more money, that increases the money supply because there's more money to lend out for the banks. When they lend out more money, that's more money supply, and that pushes this curve to the right, and that's going to lower the interest rate in the economy. So the best way for the Federal Reserve to lower interest rates is to buy to buy at mass scale um, government securities and bonds. Okay, so increase money supply, buying bonds, and decrease the money supply, selling bonds and securities. Okay, that's tool number one. That's the most widely used, and that's always what happens. That's always the first, like if the Federal Reserve wants to do something and we're in a recession, this is their first thing. They always do this first. It always works, and it's they probably would like I'm sure in March 2020, the Fed immediately started doing this. Okay, all right, we have four more tools we need to talk about, and these ones are all not as effective as the first one, but they're also tools. So number two is repos and reverse repos. Okay, and this I don't know how much this was explained in the textbook, so I got a little some more information on it. So repos and reverse repos, those are described here. And there's also some more information on this Investopedia link, but this describes essentially what's going on. And so a repurchase agreement or a repo, that's the term for it, is essentially a form of short-term borrowing used in the money markets involving the purchase of securities with the agreement to sell them back at a specific date and usually at a higher price. And so repos and reverse repos are the same transaction, but they're titled differently depending on which side of the transaction you're on. So for the original party selling the security and agreeing to repurchase it back in the future, it's a repurchase agreement. So you're agreeing to repurchase it. But for the party buying the security and agreeing to sell it back, it's a reverse repo or reverse repurchase agreement, and you can call it a reverse repo. So it's considered a loan, although it's considered a loan, this repurchase agreement involves the sale of an asset that's held as collateral until the seller repurchases it at a premium. So essentially what's going on here is the Fed can do this trick essentially to get more money into the economy. And so what they would do is they can buy um, securities or assets, and that gives that if they buy them from the bank has more money to lend out. But the agreement is that the bank agrees to buy it back at a higher rate. So if the Fed wants to use this as a tool for getting money into the economy, what they would do is they would buy some assets from banks, and then the bank will buy them back in a year, whatever, at a higher price. So the Federal Reserve makes a little bit of profit, but the banks get money to lend out, and that increases the money supply, which is going to go in that money market graph and push down interest rates. So this is another tool the Fed can use. Uh, Buy assets, hold them as collateral until the bank buys them back, and by doing that, the bank gets the money temporarily to lend out to their customers and get money pumping back into the economy. And the Fed doesn't care as long as the bank buys the asset back at a later date, and they sell it for a higher price, so they earn some interest. Okay, tool number 3 is the reserve ratio. Okay, so we learned about this last time. Remember the reserve ratio? And so essentially, it's pretty self-explanatory. The reserve ratio is the amount of reserves that banks have to keep and they can't lend out. And so if the Federal Reserve lowers the reserve ratio, that means that banks are required to keep less on reserve, like less in the vault, and they can lend out more. So all the Fed has to do using this tool is lower the reserve ratio. That allows the banks to be able to lend out more money, and that would increase the money supply. So using this as a boosting tool, lower the reserve ratio. That means banks don't have to keep as much on reserve. They can lend out more. That would increase the money supply. Tool number 4 is the discount rate. Okay, so the Fed also, because it's the biggest bank in the United States, essentially, it acts, it's one of its primary purposes is to always be able to act as a lender of last resort, meaning that they can always lend to banks if they need liquidity. And so this is the short-term loan rate at which like big banks can borrow from the Federal Reserve. So you'll see that if this is the rate to borrow money from the Fed can control, the Fed can kind of boost more money or take it out. So if they lower the discount rate, what does that do? That makes it cheaper for banks to borrow. And so if the Fed lowers the discount rate, that's going to cause banks on the margin to borrow some more money and put that money back in the economy and lend it out. And that's going to increase the money supply. So by just changing the rate at which banks can borrow, the Fed can have a huge um, impact on the amount of money that's borrowed from the Fed. Now, if they wanted to, you know, have less money, they wanted to take some money out of the economy if there was too much inflation, they could raise the rate, and that's going to cause banks in the margin not to borrow because now it got more costly, and they'd rather not borrow at the higher rate. So by lowering this, they would induce more borrowing, increase the money supply, and by raising this, the Fed would induce less borrowing and reduce the money supply. Okay, and last tool is called interest on reserves, number 5. Yes, so what this is it's exactly what it means. So the Fed also acts as like a big, a big savings account or a big checking account bank. And so if banks keep more reserves with the Fed, like if they don't, the less they lend out, the Fed pays them a little bit of interest. So the Fed can induce less lending by increasing the interest they pay. All right, so this is just the interest of money that's not lent out, right? That's kept on reserve. So if the more that banks keep on reserve, the higher the more interest they earn. But it's a pretty low rate, and so the Fed can have a little bit of control over it, but the banks are going to make more money probably lending out. And so it's only going to have a marginal effect where if the Fed wants to induce a little bit of if they want to get a little more money lent out, they can lower the interest paid on reserves. And what that's going to do is banks that have excess reserves, they're now getting less interest on the margin, so they're going to lend out more. So they become more willing to take the risk and lend out if the Fed's paying less interest. But it works in the opposite, where if the Fed wants to get a little more money out of the economy and halt some loans, they can pay the banks more interest on the reserves, and that'll cause banks on the margin to keep more with the Fed and earn that, slightly higher interest rate that's really risk-free. So clearly a lower rate they're gonna earn than lending out to customers, but the Fed's always gonna pay the rate, and by lowering it a little bit, they can induce banks to take money out and lend more, and by raising it, they can cause banks to keep a little more money on reserve and slow down inflation if that's a problem. Okay, so we've learned the 5 tools, and now we can see how they're used to either boost or slow down the economy. All right, so everyone good on the 5 tools, how those can be used by the Fed to influence the money supply? Okay, so those 5 things can either be used to as expansionary monetary policy or as restrictive monetary policy, and that's just what it sounds like. This is boosting the economy. This is slowing it down. So expansionary monetary policy. Okay. Oh, this slide 10, this shows how the reserve ratio can be used to boost the money supply. So it's a nice little graph. So this is the percent that banks have to keep on reserve that they cannot lend out. So you can see that if they have to keep more, if they have to keep more than like this is 10%, 20%. So when the amount they cannot lend out goes up, they lend out less, and that decreases money. So you can see that by lowering the interest rate, 30%, 25%, 10%, lowering the reserve ratio, that induces banks to lend out more, and that creates more money. So just by lowering the reserve ratio, that should have the effect of more money creating and an increase in the money supply. So you can see that there. Okay, so this kind of explains that open market operations are the most important that we talked about. The reserve ratio isn't used often, and the discount rate is not as, I mean, all those tools can be used, but this one is the best and the most widely used. And actually, the repos and reverse repos is kind of a nice one too, because that can they can get into different types of assets as long as they hold the asset as collateral, and then they can get more money to banks that way. But yeah, so the best thing for the Fed to do is just to buy things, right? Buy things, they take the asset, and then the banks get the money. So that's really what all these major Fed operations and the tricks it does and the um, different tools it has. They can do all these other things, but probably the most effective tool is just buy assets, right? If they buy assets, they have the asset, and the banks get money, and the banks lend the money out. So that's really the Fed's most efficient tool is just buy things. All right. So expansionary monetary policy is trying to increase the money supply, which would lower interest rates and boost the economy because there's more borrowing. So if there's a recession like we're kind of in now, the Fed can buy government securities, okay, and that's going to give more money to banks, and the Fed holds the securities as an asset. They can lower the reserve ratio, which would make it possible to lend out more, right? That increases the money supply, or they could lower the discount rate, which would make it cheaper to borrow, and banks would borrow more, or they could, or the other things, they could buy repos, right? They can buy some other financial asset and hold it as collateral as a repo, or they could pay more or they can pay less interest on reserves because that would cause uh, any excess reserves to be probably taken out on the margin. So to increase the money supply, looking at our 5 tools, buy government securities or bonds, uh, repos, lower the reserve ratio, lower the discount rate, or lower interest on reserves. So any of those 5 options, or some combination of whatever, would, in theory, increase the money supply. Okay, but what if we have inflation and we need to stop that before it gets out of control? So restrictive monetary policy is used to uh, just slow down the growth of money if there's periods of rising inflation. Okay, this could be a issue coming up. Um, so basically, to use restrictive monetary policy, just do the opposite of uh, expansionary. So if you want to lower the money supply, um, number one, sell government bonds securities, reverse repos, increase the reserve ratio, increase the discount rate, or increase interest on reserves. So you can see how all these things can be used in both directions, where just know the direction to boost the economy, and then the opposite direction is to slow down the economy. So those 5 things I listed are the tools, but you should know which way they need to be used or how they need to be used to either do expansionary or to do restrictive. So they're essentially the opposite direction. All right. Okay, so everyone good here on the 5 tools we talked about that the Fed uses, and then also how those tools can be used to either boost the economy or to slow it down. So this is kind of the main. Yep. All right. All right. So we learned about the 5 tools that are listed there in the chat and that are in the slides and in your textbook, and we'll talk about them more. And then how those tools can be used to either boost the economy, expansionary, or slow down the economy, restrictive. And we already talked about repos and reverse repos as one of the 5 tools. Yeah. So the next thing I wanted to show you is how we can use the money market illustration and the uh, aggregate supply and aggregate demand graph to kind of show how the Fed does something in the money market and that has a kind of a snowball effect into the other ASAD curve, and that's how so we're going to show a multi-panel graph of how monetary policy affects GDP, or in theory does. So let's look here at slides 14 to 17. All right, so what I'm going to show you here is a graph on the next slide, and what this is going to show is how monetary policy is graphically, how you can show graphically how it affects real GDP through the price level. And so this is the effect on real GDP and price level of monetary policy. So there's essentially like a a real big cause-effect chain in the money market that affects the investment demand market through the interest rate, that affects investment and the GDP equation, and then that affects real GDP. All right, and so we can show this to do expansionary, and we can show this to do restrictive. All right, so if you look on this next slide, there's a lot going on here, but let's see if we can make sense of this. Okay, so we can show this as two. If we start with the middle one. So all right, so we've learned all these graphs before. Uh, this one, the money market, just today. The investment demand curve we learned a few weeks ago, and then this one we learned a few weeks ago as well. Oops. Okay, so we've learned all these graphs individually, but now let's see if we can show the link together for panel A to panel B and to panel C. All right, so uh, in normal times, I'd make everyone. This would be like uh, a homework question and a test question as well. You'd have to draw these graphs and learn what's going on, but we're not going to do that because it's really difficult to do that without whiteboard and graphing paper. So you don't have to know how to draw these graphs. You just have to understand them. Okay, but all right. So let's see here. Let's start at the money market, panel A. And let's say that the Federal Reserve does one of those expansionary monetary tools, and they increase the money supply. So if we start here at, see that, what just, I mean, we're starting at 8% at 150. So SM2, which is the supply of money 2. Okay, so we're starting here. And then, or sorry, so we're starting here, and so 8% is the interest rate, and at an 8% interest rate, there's 20 million of investment, and that determines this, we're at Q full employment. Okay. Now let's illustrate the expansionary monetary policy. So if we're at SM2 and the Fed increases the money supply, then we go to SM3. So see how it goes to the right, and then this curve goes over here. So the new equilibrium interest rate is lower at 6% because with more money in the economy, uh, people are willing to pay less to borrow it. So the interest rate is lower, and if you look at the investment demand curve, there's more investment now at the lower interest rate because now it's cheaper to borrow. And if you recall the GDP equation, which was essentially consumption plus investment plus government spending plus net exports, remember that? Now the term we're focusing on here is investment or private investment. So essentially what we're saying is that when the Fed increases the money supply, that lowers the equilibrium interest rate in the money market, and that makes it cheaper to borrow, and private investment increases because now it's cheaper to do those investments. And if investment goes up, that boosts the aggregate demand curve, and so we go from here to here. So that's the cause and effect here is lower the money or increase the money supply, lower the interest rate, um, induce more private investment, and that boosts the aggregate demand curve because the aggregate demand curve is determined by those consumption categories. Okay, so see that we could this shifts to the right, interest rates are lower, investment goes up, and then the aggregate demand curve shifts to the right, and we're left at a higher GDP and a higher price level. Okay, so that's the three-panel analysis for expansionary. Now, we can also illustrate it restrictive. Let's say we go the opposite direction. Let's say we start at 8% at SM2, and the Fed, sells government securities. All right, so they sell their government securities and bonds back to the banks. The banks take those assets, and the Fed takes the money. So that pulls some money out of lending for the banks because the banks now have those government bonds and securities instead. So if the Fed sells a bunch of securities, they're taking money out, and that's going to decrease the money supply. We're going to go to the left here to SM1, and that's going to go along and give us a higher interest rate because now with less money in the economy, the the rate that people want it is higher because there's less of it available. Okay, and that pushes the real interest rate up, and that's really bad for private investment because now it's way more expensive to borrow, and there's less borrowing and less investment. And that's going to decrease aggregate demand, and we go this way. So we go to this, see this green curve over here. We go to Q1, but remember prices don't fluctuate down, right? So we're stuck here at P2 with a much lower real GDP. Okay, so you can see both directions. Where if we started this middle SM supply of money 2, expansionary monetary policy goes this way, interest rates are lower, investment goes up, and that boosts aggregate demand outward, right? And we get a higher price level and a higher GDP. Restrictive, we lower the money supply, interest rates go up, investment goes down because it's now more costly, and that'll lower the aggregate demand curve. We go this way to the left, and what we're left is with the same price level, but a much lower output here at Q1. So you can see if you can kind of weed through all these curves and graphs, uh, you can kind of see graphically the effect of expansionary monetary policy and also the effect of restrictive. Okay, and that graphical analysis is explained here. So the this is the cause effect chain for expansionary monetary policy. So if we have unemployment or recession, which we have now, um, right, the Fed can do these things to do expansionary monetary policy, like we talked about. They can buy bonds or securities. They can lower the reserve ratio. They can lower the discount rate, or just to be thorough, they could also uh, lower interest on reserves, and they could do repos. Okay, so that always put just we got 5 things we can do. So whatever they do there, that's gonna increase excess reserves because now there's more money in reserves, right? And that's gonna push the federal funds rate lower because it's now the the, the rate at which borrowing will occur is lower because there's more money in the economy, and the economy will pay less to borrow it. That's going to increase the money supply. Okay, well, actually, let's go back. So we missed we okay. So this first thing. This is the Fed using its tools to do expansionary monetary policy. So what that's going to do is going to give the banks excess reserves or more reserves to have. That's going to cause the federal funds rate to fall, and the federal funds rate is the rate at which uh, banks borrow from each other. Right? It's the uh, lending rate of big banks. Okay, and so when like Bank of America borrows from Chase or whatever, this is the federal funds rate. So it's going to push that down because there's more money the banks have now, and therefore they'll now pay less to borrow it. Now that is going to increase the money supply because the banks have more money to lend out, and they're going to do that. They're going to make more loans. If there's more loans, there's more money, and the economy is not going to pay as much for to borrow it, and that's going to push the equilibrium interest rate down. All right, that's good for investment. Investment's going to go up. It's cheaper to borrow. That's going to boost aggregate demand, which is a component of that is determined by investment. And then, like we saw in the graph, that's going to boost real GDP. Okay, so that's the story here. If you like uh, cause effect chains or flow charts or whatever you want to call this. Okay, now just the opposite can occur if instead we do restrictive. So this is just everything flipped in reverse. So restrictive monetary policy is the Fed either selling bonds and securities, increasing the reserve ratio, increasing the discount rate, and also put in reverse repos or uh, increase interest on reserves. Any of those things would be a category of restrictive monetary policy. And what that's going to do, there's less excess reserves, so the banks now have less money to lend out. That's going to make the federal funds rate push up because now the rate at which they want more money, they'll pay more for it because they have less of it. That's going to decrease the money supply because it's more expensive to borrow. Okay, and that's going to cause interest rates to go up because now there's less money available, and the rate at which the economy would borrow money is higher because there's less of it to have, and that's going to this higher interest rate is going to be bad for investment. It's now cheaper to borrow, so there's less borrowing and less private investment. Less investment means nothing else changing. The aggregate demand curve is going to shift to the left, and that's going to stop the price level, and we'll get lower GDP. Okay, so this one, this cause effect chain and this cause effect chain explain what I tried to show here. We're going this way to the right was this one, and then going this way to the left was this one. Okay, so there's a lot going on here, but hopefully this ties in. Um, so we learned all that we. So the point is we learned about interest rates. We learned about the money market, and then we learned about the investment demand curve and the ASAD curve before. So we tied all those things together, and we showed how defining all the policy tools, those policy tools can be used to try to get more money in the economy. Really, that's all the Fed's trying to do is either get more money lent out or have less money lent out. That's their whole goal, and by doing that, it indirectly controls inflation. Okay, so questions on this graphical analysis or kind of the cause effect of what's going on. So trying to tie everything together. So do we see how uh, using the three panel graph we can illustrate all the tools of monetary policy to either boost or slow down. And by boost I mean increase GDP, and by slow down I mean decrease GDP. And that's kind of yeah. Okay, so now let's talk briefly about the federal funds rate and the prime interest rate, because these are the rates that which the economy monitors, and the Fed doesn't just push a button and control interest rates, but they can have a huge influence on these rates. So let's learn about these rates. So the difference between the federal funds rate and the prime interest rate on slides 19 to 20, and then I'll see if I can find or pull up the historical up-to-date data here. Okay, so the federal funds rate is the rate banks charge each other on overnight loans. So if you want to borrow, if you're a big bank and you want to borrow money overnight, you got to pay this rate to borrow it from another bank. And so this is not, so it's not like the Fed just, goes into a spreadsheet and tells you what the interest rate is, but by using these tools, they target it, and it's very easy for them to target it. So the Fed targets this federal funds rate to push it up or down, and by doing that, that has like a trickle down effect on the rest of the economy. So the federal funds rate is the rate in which the rate the Fed tries to target, and the federal funds rate in general is the rate banks charge each other for overnight loans. Now, the prime interest rate is the rate at which uh, like this is the level at which, like, if you have a really low credit score, this is kind of the target or the interest rate at which loans for the private sector kind of start at. So this is the rate for big banks, and this is the rate for um, good borrowers, essentially, or less risky borrowers. So you can see here that they're different, but there's a clear relationship. So what happens is the Fed targets this rate, and all the other rates in the economy kind of move along. So see how they're different, but they kind of move together, or they exactly move together. So see this, it's uncanny how much they move together. So what the Fed does is they target this rate, and that rate influences the rates in the rest of the economy, kind of like that. So see how there's a gap, but what happens in the red line causes what happens in the blue line. So they clearly move together, and so the Fed can affect all interest rates in the economy by just targeting the federal funds rate. Okay, so the federal funds rate is the rate interest rate on overnight loans between banks, and let me see if this is accurate. Let's click here. Okay, yeah, this is the federal funds rate as of uh, a couple days ago. Okay, so you can see that the federal funds rate is super low, and historically it was a little bit higher, but it is so the Fed pushed it down after um, the last recession, right, close to zero. But now look at we're pretty much at zero again. So the federal funds rate is right around zero, which was the goal of the Fed. The problem is uh, there's nowhere left to go but up, and so the Fed has kind of lost the ability to induce more to push interest rates lower because it's already as low as it can go. So here's the federal funds rate, which is essentially zero, and it's been essentially zero for about the past year. Now I can show you the other one. Okay, so the prime interest rate is the interest rate used as a reference point for a wide range of bank loans. Okay, so this is the big banks get a lower rate because they're borrowing tons of money, and then customers who borrow, like if you're one of the best, or if your credit score is super good and you get a loan from the bank, then the prime interest rate is like the rate at which you get your loan. All right, so here's that, and it's not. I mean, so it's at 3.25%, which is, I mean, it was like that after the Great Recession or the last financial crisis. Then it went up again, but now it's low as it can get. So essentially, what I'm saying is that all interest rates, aside from like this little spike here, since about 2010, have been the lowest they've ever been in U.S. history, basically. Okay, so there's your uh, prime bank prime loan rate, and the when the you kind of saw the same pattern where, oh, you see this? Yeah, so here's the federal funds rate, and here's the bank prime loan rate. You can clearly see that they kind of move together. So this one's always a little higher. I mean, sorry, this one's always a little lower, and this one's always a little higher. But what happens here causes what happens here. So if I put them together, you'd kind of see the same pattern over time. So the Fed targets this, and that has an effect on this. All right. A few more things in the key concepts. So let's look at slides 21 and 22 and look at some of the recent U.S. monetary policy or recent, not recent as of the last recession, I think. Okay, so the Federal Reserve or U.S. monetary policy was highly active in recent decades. They responded with quick and innovative actions during the recent financial crisis and the recession. And they've also responded very quickly during the current pandemic with different things. Now, there is criticism that the Fed targeted low interest rates, and by keeping them low, that contributes to the crisis, or that led to the initial crisis in the first place by causing too much home loan borrowing just by pushing interest rates low. And so uh, by pushing the rates low, they're inducing more borrowing. But as we saw during the last crisis or the 2008-2009 crisis, low interest rates can have other effects we didn't intend to see initially. Okay, so some of the problems um, are lags, and it takes some time to recognize and to get the policy operational. So first you have to recognize that you're in a recession, and second of all, you have to do the actions. Um, Cyclical asymmetry means kind of like the Fed could be somewhat responsible for like pushing us both like for causing the business cycle basically. So if they do too much during a recession, that can kind of cause the economy to grow too fast. If they do too much during a recession, that could push it down. So uh, although the monetary policy is supposed to get us out of recessions and slow us down during inflation, it could also have lasting effects which continue on and kind of work beyond what the Federal Reserve intended and kind of cause part of the business cycle. And then this thing, liquidity trap, is essentially what's going on now. And this is a nice little term, which I want to talk about a little bit because it's currently a problem, and it's a nice little story you can explain to people. So okay, so let's see. Okay, so let's talk. The last two terms I like to talk about are interesting. And so we got liquidity traps and we got quantitative easing. So what is a liquidity trap? All right, so let me define it here, and then I'll show you the data of why we're currently in a liquidity trap essentially. So what is a liquidity trap? A liquidity trap is a contradictory economic situation in which interest rates are very low and savings rates are high, and which essentially renders monetary policy ineffective. This is currently a problem. So described by economist John Maynard Keynes, during a liquidity trap, consumers choose to avoid bonds and keep their funds in cash savings because of the prevailing belief that interest rates can soon rise, which would push bond prices down. So because bond prices have an inverse relationship with interest rates, which we learned, many consumers don't want to hold an asset with a price that is expected to decline. So if you buy a bond now at a low rate, if interest rates go up in a year, that asset is worth less. So you've lost money. So at the same time, central bank efforts to spur economic activity are hampered as they're unable to lower interest rates further to incentivize investors and consumers. So what we're saying here is remember um, the data I showed you last time on the money supply? Okay, so if we're ever in a liquidity trap, this is one. So because the idea here is that number one, interest rates are the Fed can't push rates any lower, and so the traditional monetary policy is no more like until interest rates go back up a little bit. Traditional monetary policy is ineffective at the moment because the Fed's already done everything it can to push interest rates low, and they are low. And you'll see that the reason why all this money is being held as essentially in checking accounts and as cash is the idea is that investors expect bond prices to go up in the future. So at some point, interest rates have to go up. And so why would investors want to buy those bonds now at a very low rate when they're just going to go up in the future? And so what's happening is everyone's holding a lot more money as currency in savings accounts and checking accounts because they don't want to buy a bond that's going to be worth a lot less in a year or less. So everyone's waiting, holding their currency to wait for bond prices to go back up because it's essentially the here's your liquidity trap. All this currency is being trapped because nobody wants to buy bonds at no return. Okay, so yeah, so you should see that you can show the data and you should be able to explain what the liquidity trap is and also why we're currently in it. So uh, a couple things are going on. Um, Traditional monetary policy is essentially ineffective because the interest rate can't go any lower, and that's caused this liquidity trap where when interest rates are too low for too long, nobody buys nobody buys bonds because the return on bonds is nothing, and everybody wants to wait till the bond prices go up again, and so there's a hoarding of money as cash just to wait until those interest rates go up, or maybe people buy other things. I don't know, but there's this this liquidity trap is clearly uh, occurring now. Okay, last term I want to talk about here is quantitative easing. So another nice term you can look smart by talking about. Um, so quantitative easing is a form of unconventional monetary policy in which a central bank purchases longer-term securities from the open market in order to increase the money supply and encourage lending and investment. So buying these securities adds new money to the economy, which also serves to lower interest rates, which doesn't matter right now, by bidding up fixed income securities. So when short-term interest rates are either at or approaching zero, which they are, uh, normal open market operations of a central bank aren't very effective, which is the current situation. So instead, the bank has to do something else, and they can target specified amounts of other assets, like during the um, during the financial crisis. What the Fed did is because interest rates got low and they couldn't do much with traditional open market operations because interest rates were already low. They had to start buying like they started buying like mortgage-backed securities because that was the asset which nobody wanted, and so therefore they were willing to hold it and give the money to banks. So they bought the less popular securities, and therefore the banks got more money that they can lend out to their customers and try to save the financial system. So when traditional monetary policy doesn't work, um, which has really only been a problem like in the last two recessions, the Fed has to do weird things and they have to buy other assets which are untraditional, which are more risky, which are more short term, and which they have to do because their traditional low risk government bonds don't work anymore because interest rates are already low and they can't push them any lower. So quantitative easing usually involves a country's central bank purchasing longer-term government bonds, as well as other types of assets such as mortgage-backed securities. So which they did, and what the Fed did last March in response to the current crisis is the COVID-19 situation. So what they did right away. So March 15th is a pretty quick reaction. So what the Fed did is they announced they were going to quantitative easing program, of about 700 billion, and they're going to do untraditional things because they realized that just doing their traditional open market operations, buying bonds, wasn't going to work, and they started doing things like buying. Um, they essentially bought like packages of stocks and bonds from banks and businesses because those businesses needed liquidity. So the Fed has been pretty um, creative in the last couple of recessions at realizing where the real problem is. During the last crisis, it was mortgage-backed securities. During this crisis, a lot of it, especially initially, was just big businesses needed, like private businesses needed liquidity, and so the Fed was essentially buying like packages of stocks from those um, big corporations. So they've done some creative things in the last couple of recessions because what usually worked for all the time of their operation became much more ineffective when interest rates were super low, which they were then and they are now. Okay. All right. So everyone, uh, everyone good on liquidity traps and quantitative easing. So again, these are fun little, well, I don't know if call them fun, but these are interesting terms, and these are somewhat new things. And if you can explain these, you can earn some points. You can impress your parents, or I don't know, go out to the bars and start talking about liquidity traps. But yeah, all right. Let's look at a couple examples. Okay, so number one is let's look at this table here for some hypothetical economy moolah and answer the question. So we got money supply, we got money demand, we have the interest rate, we have investment, we have potential GDP, and we have actual GDP. So A, what is the interest rate in moolah? So you can see the interest rate is determined at the intersection or when money supply is equal to money demand, which is right there. All right, 500 money supply, 500 money demand. So the equilibrium interest rate would be 5% because that's the only situation in which this equals this. So the equilibrium interest rate in this example here is when money supply equals money demand, 500, 500, 5%. Okay, what is the level of investment at the equilibrium interest rate? So investment at 5%, just go along the row here, it's 20. Okay, so at the 5%, investment is 20. Okay, C, is there either a recessionary output gap, which is negative GDP, or an inflationary output gap, which is positive GDP at that interest rate, and what is the amount? So if you stick along this, so we're in this row here. Okay, money supply is 500, money demand is 500, the interest rate is 5%, investment's 20, and then here's potential GDP. Sorry, here's potential GDP, which is 350, and here's actual, which is 330. So we're below our potential, which means that there is a recessionary output gap because we're below our potential of the difference. So there's a recessionary output gap of 20 because we're at this equilibrium in the money market, we're 20 below our potential, right? So 350 minus 330 means that we're at an output gap, we're below our potential, and there's a recessionary output gap of 20. So given money demand, by how much would the Moolah central bank need to change the money supply to close the output gap? So essentially what we're saying is what has to occur to get us to our potential. So here's potential of 350. That's the best we can do. So to get actual at 350, where we're at our potential, we need to get the interest rate at 4%, right? So here's when we're at our potential, best we can do. We don't want to go over. We don't want to be under like we are. We want to be at our potential. That's full employment, right? So that's like no cyclical unemployment. So when actual and potential are the same, that's an interest rate of 4%. So to get there, we'd have to make money supply equal to money demand, which is to increase it by 100. So we need to equal demand at 600, which essentially means just increase the money supply by 100, which would mean that the money supply, that straight line is now at 600. At 600, we're equal here, and we're at 4%, and everything is at potential. So the Moolah Central Bank would need to increase the money supply by 100 to close the output gap, because that would increase the money supply by 100. And then here's our equilibrium, 600, 4%, and we're at our potential. Okay, what is the expenditure multiplier in Moolah? So this one goes back a few chapters, but remember the multiplier is the change in real GDP divided by the change in spending. And here, we're just talking about investment spending. So let's look at the relationship between changes in investment and changes in GDP. So every time investment goes up by 10, 20, 30, 40, you can see that GDP goes up by 20. Okay, so just use the equations. So your change in real GDP, it's always changing by 20, and your change in investment is always changing by 10. So that's essentially a multiplier of 2. 20 divided by 10 would give us a multiplier of 2. So every time investment goes up by 10, GDP goes up by 20. So you multiply this by 2, where every time this increases by 10, this increases by double that, 20. So plus 10 plus 20. So that, yeah. Okay, and then number 2, this is essentially just what we talked about on one of the slides, but uh, show the effect of expansionary monetary policy using the following diagrams. You don't have to do this, but if you were drawing it, you do the money market, you do the investment demand, and you do the aggregate supply and aggregate demand. And I just put the diagram here, but we already talked about how, so remember doing expansionary was doing one of those or more of those tools, increase the money supply, go this way, that lowers the interest rate, that increases investment, and that boosts aggregate demand, which increases real GDP and pushes up the price level. Okay, so expansionary monetary policy is pushing the money supply this way, lowering the interest rate, increasing investment demand, and then boosting aggregate demand, shifting to the right, which would get us to a higher level of GDP. Okay. Okay. Questions on any of this material before we look at the homework assignment? Everyone good on all these concepts and Mhm. Okay. All right. All right, so here's your last homework, and this is probably the least math-based analytical one. It's just kind of it's one question on fiscal policy and monetary policy. So all you gotta do here is part A, list the two main economic issues that would require the use of expansionary policy. All right, whether you're looking at fiscal or monetary, and then we listed one main economic issue that would require the use of contractionary policy. So what are the two things in which we'd want to boost the economy? What are the two problems? And what was the one main thing we'd want to use contractionary policy? So we talked about those things. Okay, B is we discussed two tools that the US government has to conduct expansionary fiscal policy. So just list and describe how each policy tool would lead to an increase in GDP. All right, or you can use 1 to 2 sentences, or you can use bullet points, or you can just explain, uh, and you can use the GDP equation if you want. Uh, GDP equals C plus I plus G plus X. That one. Okay, so list the two things, or the two ways in which the two fiscal policy tools in which we can conduct expansionary monetary policy, and just explain how those would boost the economy. And then C, we just talked about the five tools that the Fed has to conduct expansionary monetary policy. So just list those tools, right? The five I put there in the chat, and explain how those can be used to expand the economy. All right. So list the issues, the two issues for expansionary, and then list the two issues for contractionary. And then remember the fiscal policy tools were government spending and taxes. And so explain how each of those two tools can be used to conduct expansionary policy. And then the five tools for monetary policy are right there in the chat. Open market operations, repos and reverse repos, reserve ratio, discount rate, and interest on reserves. Okay, so list those, explain how those can be used to conduct expansionary monetary policy. So basically, all you're doing is listing the issues we need expansionary policy, listing the one issue we need contractionary, and then how can the Fed or how can the U.S. government use its two tools to boost the economy, and how can the Fed use its five tools to boost the economy. Okay, so you don't need any math. You just kind of list the tools and kind of explain briefly how those things can be used, like we talked about in the last couple chapters. Okay, so this shouldn't take you too long to do this one, but any any questions on what I want you to do here? Everyone clear on what the questions are asking? Okay. Okay. All right. Let's see. Okay, so yeah, just a reminder that the chapter 14 homework is due today. And so if you haven't done that, try to post your chapter 14 homework today, because that's due there. And then the chapter 15 homework that we just went over is your last homework, and that's due next Monday, which will be our last meeting. So we have one more meeting, and so we finished all the new material. But what I want to do next time is kind of review everything from chapter 10 to 15. And so our next meeting, we'll do some practice questions. We'll do a little review session for the final, and then all you have left, assuming you do all the homework uh, by next Monday, then all you have left to do is the take-home final, and that's essentially our last piece of information, or last item for this class. Okay, so get your chapter 14 homework in today if you haven't done that. Chapter 15 homework is due next Monday, and then during our last meeting next Monday, we'll do a review session for the take-home final. All right, sound good? So I think that's what I wanted to cover for today, and yeah, that's it. So thanks for joining. Have a good rest of your week, and our last meeting is next Monday, so I'll see you then.
Thank you.
Thanks, Professor. See you.